So welcome to all of you to this session on how to improve small firms' access to bank finance, evaluation insights from the EIB, EBRD, and the ADB. I really have the privilege to moderate this panel with three very distinguished speakers, experts in the field of evaluation, SME development, with extensive experience in different geographies. So let me introduce myself. I'm Ashwani Muthoo from the New Development Bank, and I would like to now introduce the panel members very briefly. Ladies first always, right at the end of the table, Gloria Paniagua. Is that how is that fine? Paniagua, yes. She is a senior evaluation specialist in the Independent Evaluation Department at the Asian Development Bank. She has a track record of having worked in the IFC, the World Bank. IFPRI, I was looking at her bio. I'm impressed also at the Brookings Institution in the United States, and has extensive experience in SME development in different regions, Central America, Asia, and others. So welcome to the panel, Gloria. Gabriele Fattorelli, Director for Corporate Thematic and Knowledge Evaluation Products at the EBRD, London. Gabriele has extensive experience across the MDBs, having worked in the Asian Development Bank, the African Development Bank. He has also worked in the OECD DAC. I'm not sure, have you worked in the World Bank as well? Also in the World Bank. I heard him speak earlier, although it's not in his bio, that he's also worked in the Inter-American Development Bank in Honduras. So he has extensive experience and is currently director at the EBRD. Last but not least, we have Aron Gereben, who is currently evaluation expert team leader of the evaluation division at the European Investment Bank. Aron has worked at the bank in the European Investment Bank in different roles. But interestingly, he's a macroeconomist and has worked for the Central Bank in Hungary and also the Reserve Bank in New Zealand. So he has also extensive and very broad experience. So welcome to all three of you to this panel. The way we will conduct this discussion is that we will have three presentations of case studies of work done in the respective organizations by our speakers. And then we will open for a round of questions to them and then to you as well. So please follow the presentations carefully and see if you have any questions you want to ask the panelists. So we'll address them to them, those questions to them. And then we will have another round as well of questions. So that's the format of the discussion. And without any further ado, I would like to ask the first presenter, Aron, from the EIB, to take the floor to deliver his presentation. Each presentation will be 7-8 minutes long, maximum 10, that's the time limit. Aron's presentation, as you can see, is an evaluation of the EIB Group debt support for small business and mid-caps. Over to you, Aron.
So thanks, Ashwani. Thanks for coming and joining us after lunch. I know it's a challenge. And also, I would like to thank the organizers for providing us the opportunity to present our evaluations on the topic of supporting small businesses and mid-caps. So my name is Aron Gereben. I work for the evaluation division of the European Investment Bank. Some of you might not know what the European Investment Bank, the EIB, is. We are a multilateral bank owned by the member states of the European Union. We support investment projects both in the private sector and also in the public sector. The bulk of our operation happens or takes place within the EU, but about 10% of our lending is outside the European Union. Most of that in the region, the neighboring region, but also we are present in practically in all continents. So what I'm going to talk about is an evaluation that we finished recently about the EIB support to small and medium-sized enterprises. So before jumping into the evaluation details, let's spend a few minutes on discussing why multilateral banks like the EIB are interested in being present in the SME financing field. And the reason for that is what we call the SME financing gap. SMEs, small firms, are the backbone of most of the economies. Within the EU, more than 99% of the firms are actually SMEs. They provide about 2/3 of employment, and they contribute to half of the value added. And also, they are an important part of the innovation process that leads to productivity growth. At the same time, we find that SMEs often find it difficult to access finance from banks and from official financial institutions. And the supply to SMEs in terms of external finance is usually thought to be below the social optimum. So there is a role for public sector to jump there. Also, when we look at the SME financing gap, we find that generally it's more pronounced for younger firms, smaller firms, firms that are engaged in innovation, and also for firms that have like limited available collateral for lending. Another aspect of the financing gap that it varies quite significantly across different regions and also over time. On the right-hand side, you have a chart that looks at one indicator of a survey-based indicator of SME access to finance. And you can see that there's a huge heterogeneity across the different EU countries, and also there are big swings from one year to another when it comes to SME access to finance. And the last point is that besides the generic SME financing gap, more recently there is more and more attention to thematic investment gaps, for example, in terms of green financing and supporting SMEs in the green transition. So what is our evaluation about? So the scope, we define the scope as all EIB operations where we are providing a loan, a debt product, and the beneficiary, the final beneficiary of this loan is a small firm. This covers a range of products from credit lines to credit guarantees. I will get back to this later. It's also group level relations, so it includes not only the EIB, the bank, but also our partially owned subsidiary, the European Investment Fund, which is also very active in the SME field by providing credit guarantees. In terms of time horizon, we are covering about 14 years from 2010 onwards. This period includes a lot of heterogeneous events ranging from the EU sovereign crisis, the COVID, and so on. And the scope, we are limited the scope to EU countries only, and we are evaluating the relevance, the effectiveness, the impact, and the financial performance of these operations. Quick look at the portfolio. So over these 14 years, the amount of total support to SMEs amounted to, through the EIB, amounted to 270 billion euros. Another interesting aspect is that the overwhelming majority of this support took place through intermediated finance, where we are channeling our support or funding through financial institutions, and they are on lend these resources to SMEs. So these are indirect operations in this sense. What we provide to the financial intermediaries could be lending in the form of credit lines, or it could be portfolio guarantees to enhance their risk-taking capacities, and there are some in-between products. About 70% of our support took place in the form of credit lines, and about 20% as credit guarantees. If you look at the dynamics of the portfolio, we can see that there was a gradual shift from the credit line type of products towards the risk-sharing type, guarantee type of products. So what are the key findings? First of all, the first finding that we had in this evaluation is that we had an increasingly diverse portfolio over time. So we started with a set of operations that were almost exclusively to form as credit lines to financial institutions. And from then, we were diversifying away towards deploying risk-sharing, credit guarantee type of products. Another dimension that we where we achieve diversification is from generic SME type of support. We are increasingly turned towards thematic products, especially in the field of climate, but also SME support products focusing on gender, on digitalization, and other thematic objectives. And also, we try to diversify more increasingly towards alternative finance providers as opposed to traditional high street commercial banks. A second finding of the evaluation is that quite often the targets or the objectives of our SME operations were not fully specified, and they were often, we found in the evaluation that they were often quite unclear. The products tend to aim to SMEs in general, without little focus on the niches where our support is needed most, and also we didn't took into account the type of financial constraints that the SMEs are facing. A third finding that we put forward is that overall these products have been deployed quite successfully. At the same time, the EIB failed to adjust its offer rapidly enough to the evolving issues and constraints of the financial intermediaries. And the fourth finding is that while we have quite a lot of good information on the financial intermediaries, the banks that we are working with, the institution devoted relatively little efforts to learn about the final beneficiaries themselves. So as we are working with the banks, they are our clients. Our operations tended to forget about the ultimate objectives of these operations and looking at the small firms themselves. So just to conclude, we put forward 4 recommendations based on all that. Our first recommendation was for the management to define a group-level SME strategy with the hope that such a strategy will enable the bank to provide clearer targets for SME operations. The second recommendation was to strengthen the incentives for our thematic products. As I mentioned, in the last few years, we focused more and more on thematic SME lending, especially in the field of climate change and green products. And there, what we found is that the bank should do more in terms of incentivizing the financial institutions, the intermediaries, to do more in these fields as opposed to what they would have done otherwise. And also, we should try to provide more incentives to the final beneficiary firms to change their behavior, change their investment towards green products, possibly in the form of blending our loan products with grant elements. The third recommendation was for the bank to be ready and to be more flexible in terms of adapting to the needs of the financial intermediaries. We found that the needs of the financial intermediaries change over the economic cycle quite significantly, and in order to have the maximum efficiency for our products, we need to adapt to these needs. And the fourth recommendation was to focus more on the needs of the final beneficiaries, understand their needs better, understand their customer experience with their products, to give them an even better support when it comes to increasing their access to finance. I'll probably stop here and give the floor back to Ashwani. Thank you.
Thank you very much, Aron. You just about stayed within time, but thank you very much. I'm not going to summarize anything you've said, but 2 things did strike me, and I'm sure many of the other things he also said was quite revealing. And I think we face this in most of our organizations, the thing about the objectives and the targets being unclear up front in design. This is quite a recurrent feature in our we find this in our evaluations. And actually, just going beyond just the targets, most often, when you have objective statements which might be clear, they're not prioritized either. The objectives are also not prioritized. So I think that's an issue. The other thing which struck me was the issue about limited knowledge. And I think this is something we collectively need to devote more attention to in the evaluation community, the dissemination, the lessons learning, and so on. But with that, let's move on to the next presentation by Gabriele. He will present to us and evaluate the preliminary findings and reflections from an evaluation of EBRD support to small business initiatives, phase 1. Over to you, Gabriele.
Thank you, Ashwani, and thank you very much for indeed inviting me to present this evaluation of the EBRD support to small, medium enterprises. As you well spot, Ashwani, we are discussing about preliminary findings and reflection because this presentation is actually a premiere in the sense that we just finished this evaluation and we haven't presented to our board yet. So I will not go really into the recommendations, but I will share with you indeed some findings. And for the EBRD, this line of business is very, very important. As you know, EBRD business is around 75% focused on private sector. And because also the composition of our countries of operation, including Central Asia, North Africa, and now the expansion to Sub-Saharan Africa, this work that we do with for supporting small, medium business ventures, it's absolutely. In terms of what I will going to quickly present to you, it's basically what is the EBRD unique approach to that. I think that is quite a differentiator compared to what other institutions like EIB do. I will just touch very quickly on the methodological approach because it was quite innovative since we had to finalize the evaluation within almost 4 months only. And I will share with you a few key findings, what we have learned from that. So the big innovation of the EBRD is that before the creation of this umbrella that we call the Small Business Initiative, there were so many different products for SME dispersed across the institutions. And this umbrella in 2016 brought all these different initiatives together in the same department, under the same coordination. Overall, it represented 13% of the whole business of the institution, something around 1.5 billion per year. And we offer basically three types of services. As EIB, we focus on indirect financing, and we offer similar products, although customized maybe differently to more than around 250 local banks and microfinance across the region, with a specific focus to promote inclusive growth and to target women entrepreneurs or small companies adopting energy-efficient practices or innovation-driven companies. But we don't offer just the financing. We offer also a number of technical assistance and expertise to help the financial intermediaries to design better their products for the SMEs. We also offer, which is quite an interesting thing, direct financing. And basically, when the market is in the market, the financing opportunities are very limited, and we see the potential. EBRDs finance the companies directly, and that is particularly important for our mandate because what we aim at is the demonstration effect, right? So we wanted to create innovative financing product targeting small, medium companies in which we believe there is potential to create a demonstration effect, to see that is profitable and sustainable. And the third is a line that is, has been created in 2015 that has accompanied both the two type of financing is the business advisories. And we will discuss maybe that later. So, but basically what we offer is an end-to-end framework to improve the management practices of the company or the ability to achieve international standard, corporate governance, financial transparency, and so on and so forth. This business advisory was quite a distinguished feature of the bank. In terms of the approach, so we, for many reasons, we had to deliver this evaluation in a very tight timeline. And we tried to employ a phase approach where we focus the first phase that I'm going to present now basically on one question. That was to what extent the EBRD support to SME has been relevant to the needs of the private sector in our region. To both the need and the demand, actually. So that is, I think, one of the big questions. How we were able to address the needs of the private sector in our countries of operation. We also look a bit at the coherence, internal coherence, how we are consistent with our strategic mandate and priorities and so on, and external coherence, how we coordinate with other IFI. One important point is that we use when we discuss about SME, we use the EU definition, the EU metrics about 200 plus employees or 2 million in euros in revenues for the company, which is a quite strict approach in the sense that already when we move to other regions, not in Europe, but in Central Asia or in Africa, this may create some concerns. So completed only in 4 months, which is sort of a record in our evaluation realm. And the reason is that we could use artificial intelligence for extracting from a number of external evaluation committed by donors, key findings and key evaluation insights that contributed to build the knowledge of this evaluation. Not just, of course, artificial intelligence, but that was just to connect it to the panel that we had this morning. Now, very quickly, going to the few findings that we identified. So we tried to compare, to build a sort of counterfactual. How effective has been this approach to bring together under one umbrella all these different type of services vis-a-vis the previous, maybe more ad hoc approach that EBRD used to employ before. And what we learn is that we got a lot of efficiency gains, as you can imagine, especially for the indirect financing. For example, the internal approval process got streamlined, and the speed of disbursement was reduced by a significant ratio. The good news is that the portfolio didn't deteriorate vis-a-vis this increased speed. The other good news was that this approach was quite useful to push other strategic priorities for the institution. So we had an increase, for example, in our green investment ratio. Digitalization, the digitalization approach has been embedded in several of this financing. So it was absolutely positive. And the business advisory service was so important during the crisis time. And maybe I will get back to that later, but I want to just mention that just in 2021, 30% of the SME business advisory were dedicated to crisis response. And overall, in the last 10 years, we reached more than 10,000 companies through that. As was discussed this morning, there is always a space for improvement. And still, for example, the integration of these three pillars, these three dimensions, has not been fully achieved. Also, the approach to measure results of each one of those and collectively has not been fully put in place. So it's particularly difficult to get a sense of the impact that we actually achieve. But what we have found also is that this is really a key approach for differentiating the EBRD towards all other similar initiatives. And that becomes particularly important when it goes to the demonstration effect, driver that we believe is so important when we will expand to other regions and other countries. So all in all, I think that was a really positive outlook for this initiative, and I think that this evaluation hopefully will be another step forward to improve the support to SMEs by our institution. And I finish here. Thank you.
Thank you very much, Gabriele, for that presentation, also within time. I found interesting everything he said, but particularly one of the findings about the importance of business advisory support. I feel that, at least in my institution, from our evaluation perspective, we keep on emphasizing the need to marry advisory services and technical assistance, capacity building, with funding for hardware and the significance of doing that. So I'm seeing that similar findings are emerging in other institutions. And the other thing which I thought was interesting was on the approach, methodology, process, the phased approach to doing evaluations. Something I'm personally not too familiar with. We're doing that now in one of our evaluations. We are completing an evaluation of NDB's project cycle for sovereign operations, and we'll do as a separate evaluation in the second phase an evaluation of the project cycle for non-sovereign operations. So I thought that was interesting. But last but not least, you emphasized the timeliness of this evaluation. Timeliness, I think, is the two dimensions we need to remember. One is not only the timeliness of the topic that you choose so that it fits into further processes, policy development or whatever, but I think we in the evaluation community, in the MDBs, UN, IFIs, we are at times accused of taking a long time in doing our evaluations. So the delivery, I think, of evaluations also is something that we need to be cognizant about. But having said that, let's go to the last presentation by Gloria, who will share with us ADB and experiences from ADB support to micro, small, and medium enterprises, an evaluation that covered the period 2018 to 2023. Over to you, Gloria.
Okay. Thank you very much. Good afternoon, everyone. I'm happy to join the panel. Actually, my presentation is slightly different from the other two because I'm going to be presenting the project level. The Independent Evaluation Department, we do validations for both sovereign and non-sovereign operations. And we do this on and for non-sovereign operation, we actually do this at 100%. So this is slightly different from validation. I'll explain what validation is in upcoming slides and some of our findings and lessons from the projects that have supported micro, small, and medium enterprises. But before I get started on that, let me go ahead and also talk about some of the other reports or type of evaluations that we conduct at IED. That was particularly focused for micro, small, and medium enterprises. So in 2018, we did a thematic evaluation on the support for SMEs, which focused on the business environment, on access to finance, on value chain, and on women in business. To complement later on in 2020, during COVID-19 pandemic, we did a synthesis note on the lessons learned from previous support that had been given to micro, small, and medium enterprises during crisis situations. And then in 2020, we did a sector-wide evaluation on ADB's finance sector operations, which included a focus on inclusive finance, which at ADB we define as covering MSMEs and leasing, housing finance, microfinance, micro savings, and microinsurance. And in that evaluation, in particularly, found that almost 90% of those projects that were supporting inclusive finance for private sector operations were within the MSME and leasing operations. Now, let me talk about a little bit about what we do on validations. But before I get started, can you raise your hand how many of you in your institutions actually do validations or know what validations are of projects from an independent point of view? 3, 4. Okay, great. Okay, so let me explain how this works. At IED, we follow, just give you a background, the Harmonized Good Practice Standards, or GPS, for those of you who know, for evaluating private sector operations, which were established by the Evaluation Cooperation Group a while back. What happens is they set certain criteria for when projects reach what is called early operating maturity. And in the case for financial intermediary loans, is between 30 to 36 months after final material disbursement at the project level. So it's usually between 30 to 36 months, or 2.5 years after the last disbursements. The projects are eligible to be evaluated. So in this case, the operations teams, or in the case in ADB, the portfolio management teams, they do a self-assessment of the projects following certain criteria. They follow the 4 criteria that are there, look at development results, which includes 4 subcategories, which I won't go into it at this point. They look at additionality, work quality, and investment profitability. Once they do their own assessment, then we, the independent evaluation department, gather and validate whether the ratings, whether we agree with the ratings or not, and then we provide a overall assessment on the success of that project based on looking at all those 4 criteria. So in this case, and actually this exercise was we did this exercise for this panel in particular, where we identified those projects within the financial institutions departments that were SME focused or MSME focused that provided support, which we validated at IED between 2018 and 2023. And the sample consists of 25 projects. Most of those projects provided support in the form of loans, equity, and guarantees. And this support is done through private sector financial intermediaries. So just to be clear, I believe EIB also does it through intermediaries as opposed to EBRD that actually gives direct financing to SMEs. And then these financial intermediaries are usually banks, commercial banks, or they are non-bank financial institutions, which include MSME and leasing. That's our largest portfolio. The type of support that we provide can be either very general to SMEs or MSMEs, or some of our interventions are a lot more targeted, where we actually, go and specify, this is in a rural area or a lagging state in the case of India, or post-conflict areas, which is usually, we have a project in Sri Lanka, or specifically if it has a gender component or a gender target, whether it's a woman-led MSME or a woman borrower. So, what did we find from our validations? We found that overall, only 52% of those projects that we validated, we rated as successful. Most of these were loans provided to MSME lending or leasing activities, and we identified the main reasons for good performance. And these were mainly attributed to two. One, they had proper diligence in choosing the right partner financial institutions, and I can elaborate a little further during the Q&A. Secondly, having the right structuring the intervention well, and in some cases through programmatic approach. Some projects that did not perform well were mainly due to the following: structuring and design issues, having very complicated design and monitoring frameworks. That's a very specific thing that we do at ADB, which is defined monitoring framework, or DMF. Is really basically the logical framework of a project where you have output outcomes. We don't look at impacts, but basically that's what it is, and they come up with different indicators. And they've been so complicated from our review that even the clients couldn't monitor a report on them. Another area for poor performance is that setting very unrealistic targets or having very poor baselines. Another reason for why projects did not perform well was also they don't have in-house appropriate tracking or reporting systems. And then lastly, which is what Ashwani mentioned, is the lack of having a well-defined what an MSME is, or identified in actually issues of like targeting the right beneficiaries. Now let me move on to one of the other components that I think is very important that we all MDBs look at on the private sector part, to look at additionality. When it comes to additionality, we look at both financial and non-financial additionality, and we found that only 48% of those projects that we validated were rated satisfactory for additionality. And the main reason for satisfactory rates were for two, and they're both financial additionality when it comes to ADB. One is that ADB provided a type of provided local currency or long-term financing that is not readily available in the market, or ADB helped catalyze funding from other commercial sources, and in this case, usually in the form of B loans. And the main reason for having less than satisfactory additionality is the company would have raised the funds regardless of ADB participation. The project would have gone ahead regardless. Secondly, there's often a presence of other IFIs or commercial financiers that have been there prior to ADB intervention. This is often the case. I mean, we're constantly competing with our colleagues from EBRD, colleagues from IFC, others in the region, even AIB. And it's often, it's difficult to show, for example, if there have been improvements in environmental and social management system, whether that was because of ADB intervention or was it because, EBRD was there before or IFC was there before. There's also, the projects were not able to actually provide evidence to substantiate whether they actually had helped mainstream gender objectives, or whether the technical assistance that was provided actually improved the capacity development of the institution. And lastly, I'll just highlight some of the lessons learned from these validations. One, we found the importance, as I mentioned, of choosing the right participating financial institution as a partner, and also the right timing of ADB intervention. Two, the importance of selecting smart performance indicators at approval, and actually more importantly, is being able to agree with the client. We saw cases where actually some of the definitions were not clearly communicated with the borrower, so there was no way that they could actually even report on them because they didn't even know what the indicators were. A third lesson learned was to do proper due diligence to avoid project design and implementation issues, to do it at the right time. A fourth lesson has to do that if you are going to include technical assistance to an investment, make sure that that technical assistance is relevant to that particular project, and that it actually can enhance the development impact and the financial viability of that project. And lastly, to make sure that you have the right systems in place, or that the right systems are in place there to be able to monitor and report achievements of those performance indicators. With that, I end my presentation. Thank you.
Thank you very much, Gloria, for that very interesting presentation as well. I really concur with many of your findings, particularly the importance of choosing the right partners. In this case, the financial institutions, but I think this applies to all development interventions. We, in our recent evaluations in NDB, we're noticing that strong executing agencies and partners are critical to outcomes. This is, I think this is maybe something that all of you also relate to. Plus the issue of design complexity. I think this, particularly in SME financing, I think this is a challenge in SME financing. It might be less of a challenge in other sectors. I don't see that too much in NDB, particularly in infrastructure-focused operations. But having worked in IFAD for 30 years, agriculture is very complex, and therefore I saw design was very complex because of the multiplicities of inputs and services you have to provide to achieve success. But having said that, let's move into the dialogue. We have 3 very interesting and diverse presentations which follow a different scope, different methodologies, process, topics. So I think it'll be an enriching discussion. I will pose some questions to the panel first, and then I'll come to you. So let's start with the first question I have in mind. And I will start with Gabriele, if he doesn't mind. Yeah? Sorry to pick on you, but you're in the middle, so you're in the middle. Can you elaborate a little bit more, excuse me, from the EBRD perspective, whether you think that EBRD support for programs are answering the actual demands of small firms? And in addition to that, do you also feel that the firms, are they able, that the programs that you're funding, are they able really do they aim for firms that are most in need for accessing external finance? So 2 parts in a way to the question. So if you could elaborate a little bit on that from your experience, and then I'll ask the same question to the other panelists as well. Go ahead.
Ashwani, it is indeed the question, right? I mean, so how our intervention are able to address the needs of the market, right? So our evaluation maybe can just give a partial answer to that. So, and maybe there is a need also to distinguish between the need and the demand. And I will elaborate also on your point when you say we need to choose the right partners. Okay, so so first the positive thing. So overall, the analysis showed that the EBRD support to SME was indeed relevant, and to some extent addressed the demand of the SMEs that were targeted, right? The SMEs that could access to that for many reasons. For the EBRD unique approach to tailor the financing on the specific need of either the financial intermediary or the direct financing, the company. Key element of the EBRD design, such as first loss guarantee, the type of first loss guarantees, the loan repayment periods, the grace period as well, have made this type of financing really accessible to a certain type of SMEs. In additional cases, we have, in some cases, we have also evidence that the demand for this type of financing and advisory service has exceeded the initial expectations. Now that is just one side of the coin. So it was very, very interesting to notice that a substantial segment of the SME population, of the SME universe, had actually no really access to the benefit of our advisory services, of our finance, right? And that maybe because of, there was different reasons. I mean, I took note of a few. For example, we asked for, both for indirect and direct financing, some contribution from our partners or from the companies. And that exclude a target of vulnerable SMEs, right? I mean, now you are right. I mean, we need to choose our partners as well. But is also the question I want to pose to you is the role of a development institution to leave someone behind and not to help even to the whole universe that we aim to target to some extent the same opportunity. So I stop here. Thank you.
Thank you very much. Particularly this finding about the cost-sharing arrangement for advisory services and how that excludes vulnerable firms. So let's go now to Aron with the same set of questions, please.
Our evaluation had results which are to some extent similar to what Gabriele was already mentioning. So overall, we found that the EIB operations were addressing relevant need. At the same time, we found that more could have been done to tailor our products to meet these needs of the SMEs a little bit more. And then I would like to highlight two aspects of that. The first one is about the type of SMEs that we are targeting. To give an example, the plain vanilla credit line product for SMEs that we have works in a very simple way in the following format. Like we give the bank, the commercial bank partner, a loan at relatively favorable terms, and then we ask them to report back that for the same amount of, or a little bit more than what we give you, please report back SME loans that you carried out. And we give them a definition of SME, which is the same as the EU official definition of SME, which includes firms up to 250 employees. So, and the banks, of course, they try to do this in an easy way. So they target the best and the nicest of these firms. At the same time, what we observe is that within this very broad SME definition, there are some niches which are particularly vulnerable to access to finance issues, younger firms, women-led enterprises, innovative firms, smaller firms, and so on. And what we found is that while we had some products that were trying to tailor the needs of these specific needs, we could have done much more to go into this direction. The second example is like the way our products are designed, especially our flagship product, the credit line product. We have to understand that financial constraints and access to finance issues come in different flavors. They can be cost, like loan is too expensive, or they can come in more like volume type of constraints, like SME is discouraged already by the bank to apply for a loan, or even if the firm applies to a loan, it often gets rejected, or even if it doesn't get rejected, often firms receive less than they applied for. And our flagship product was shooting mainly at the cost issue. And when we look at SME surveys in general, cost is a relevant issue for SMEs, but it's not the main type of constraint that most SMEs face. So another finding of ours was that we could have done more to address the non-cost type of elements of access to finance, the rationing type of issues that many of the SMEs face.
Thank you, Aron. Let's go to Gloria. Gloria, your thoughts on this?
Okay, sure. Thank you very much. As you know, our approach is slightly different, right? Because when we do the validations, it's at the project level. And I guess to answer your question, whether we're actually aiming at the most, in need of external finance, I would probably have to say no, especially since 48% of those projects that we validated, we rated as less than successful overall or unsuccessful. And one of the main reasons, as I mentioned in the presentation, was because of issues of not having a clear definition of what, who is the qualifying MSME, or having a clear lending targets for each of the intended beneficiary groups. We learned as we looked at the various projects that some of the projects that actually did well were those that actually were able to identify, define specifically targeted areas, such as what geographic areas they're looking at, where banking services are the most limited and the most needed, where you identify, for example, the size of MSME borrowing, whether you use sales, revenue, or number of employees, or whatever other definition. Also identifying, for example, the ownership of an MSME. That was quite important, whether you're targeting a group of women, single women, women-led MSMEs, or the type of sector or business that this intervention is trying to address. There's agriculture, manufacturing. Having said that, it's also very important for the financial intermediaries themselves to be able to identify which are the MSME borrowers and sectors that they see are most supported. And we saw that wasn't necessarily there all the time. But I'd like to actually highlight a couple of examples that were successful in doing this from our validations. There was a case in Armenia where the financial intermediary actually adopted and used the government definition for MSMEs based on what the government wanted, number of employees, revenues, and assets, I believe. And they also targeted a particular area, that at least 30% of the loans provided to MSMEs from the ADB loan had to be targeted to areas outside, activity had to be done outside the capital city of Gereben. We had another successful project, which is also very targeted in India, where they actually identified the MSMEs had to be in a certain rural area or semi-urban area, had to focus on agri-sector, or and had to really target women borrowers. So those interventions that tend to be much more targeted tend to perform much better.
Thank you very much. Thank you very much for those insights, further insight. I want to actually now open up the floor to all of you. We have about 25 minutes till 3 o'clock. We could stretch it a little bit if you permit, if needed. But I think it would be very useful to not only to listen to your questions, but also in case you have any perspectives that you want to share from your experiences that are not necessarily questions, we'll be happy to listen and learn from each other's experiences. So we have microphones, I see. We have microphones in the room on the sides, so you'll have to stand up and go to the microphones. I see 4 hands already, and I will come to each of you. Please introduce yourself when you go to the microphone, and please say your name and which institution you are from. So let's open up. So the lady in the front table first, if you don't mind, a seconder. Over to you.
I told myself today I'm not going to ask questions. For the last 2 days I have been, but then the discussion becomes so interesting.
Microphone, please.
Sorry. So my name is Samar Ihsan. I'm Additional Secretary at the Ministry of Economic Affairs in Pakistan. And I supervise a lot of projects by the MDBs. So my question is to Gloria. Gloria, you were saying that when you start your validation process, or when you, after the evaluation period, so it basically starts after 30 months onwards, right?
Why don't you please go ahead and she can clarify.
Yeah.
Okay.
So basically, what I wanted to know was that we come across lots of projects where they do not close on their original closing date. So we get, sort of requests from the implementing partners to increase so extend the closing dates. So how does that affect your validation process later on? Because the extension dates have changed. So there is more period added to it. So naturally, for the activities and all also, they have more time. So does that affect your validation process in any way, or it doesn't? So just wanted to hear that. Thank you.
Thank you very much. And so we have a lady. No, second, you're going to be last. We have 2 more ladies. So I'd like to give the lady on the right-hand side, my right-hand side. Yes, please go ahead.
Thank you. It's very interesting introduction of those projects and also the results. So I have a question to three of you. And
Sorry to interrupt you. Please introduce
sorry.
yourself again.
I keep forgetting introducing myself. This is Ting Yang. I'm independent evaluation researcher and consultant. I did my PhD on evaluation in the Institute of Demand Studies, and I've worked with some of you already. So my first common question to three of the panelists. I got involved in quite a lot UN evaluations, but less in MDB evaluations. So I'm happy, I wouldn't say happy to see the commonalities of issues or problems in evaluation, but there are indeed very, I would say, similar issues reoccurring. For example, the design and the implementation issue, targeting issue, and also the M&E approach issue or availability issue. So the common question to three of you is that, is there any space for theory-based evaluation given MDB?
No, sorry, could you please repeat that question?
How much space for MDB evaluation for theory-based evaluation?
Theory-based evaluations, yes.
Because I keep hearing the issue of measuring or assessing capacity development and other software issues, using your word. So the particular question for EBRD is, I really like the approach of phased one. Then my question would be, how about the aggregate level results when you come to that stage? And my question ADB is, it's interesting to say poor baseline, because I would think there is no poor or a good or bad baseline, it's just a baseline. So I wonder whether there is need assessment conducted. Of course, that relates to the design issue. Is it clear?
Yes,
okay,
yes.
Thank you.
Thank you so much. Very, very thoughtful questions. This lady at the back, please. Yes, over to you.
Yeah, so thank you, and hi everyone. I am from Mongolia, and my name is Olga. I represent the Mongolian Evaluation Association for the development of evaluation, and I also work as an independent evaluator to get paid to survive in this life. And yeah, thank you for the very fruitful discussion and touching the very important topic. So my question is, oftentimes or usually the small firms or the small businesses are led by the specific social groups that always labeled as vulnerable groups, right? For example, youth, women, or the local farmers or local herders, etc., and sometimes people with disability too. And I understand that the multilateral development banks and the UN organizations, such as like all other international organizations, try to support these social groups and implement like various programs. But in the real life, they always struggle with like access to those microloan programs. Even some of you already mentioned in your presentations, for example, such as like high interest rate, and they require collateral to give the microloan, etc. When youth does not have any long history, right? So were your evaluations were able to identify if those kinds of challenges for those social groups addressed by your programs that is initiated by your banks, or if not, were you able to provide some specific recommendations on how to increase the access your program to those in like hard to reach community, right? Or if yes, could you please share us with a very good example or best practices that worked well? So I just heard that there was a specific requirement in the indicator that is requiring the program to cover specific regions or like women's, etc., right? But even so, that is kind of very limited way, I think. So could you please share us more effective ways to solve this problem. Thank you.
Thank you very much. Thank you. Sikander, over to you. Last but not least, please. Please go ahead.
Hello. Thank you, Ashwani and the team. It's very interesting and thought-provoking discussion. I'm Iskander. I'm leading the evaluation unit within AIB. I think my question goes to Gloria, and then a little bit to Gabriele. I'm really surprised the finding, which is evenly split, literally 50-50, almost, the successful ones and the unsuccessful one, right? Out of 25 projects, 13 projects were rated successful, which, are you surprised? I mean, I'm really surprised, because given the amount of portfolio that really went on, so how was the reaction from the investment team? And also, is it rating consistent with their own self-evaluation and rating? Because I used to be on your role when I was in IG. I used to do IFC's XPSR when Marvin was there. And then I changed my hat and I moved to the investment side, again, doing investment. So it's really scared me. I mean, if this, I don't know, it must be triggered a huge discussion within ADB, given the amount of billions of portfolio is really channeled on this sector. Then is there any corrective action now under discussion with the management then? I mean, if 50% of the portfolio are unsatisfactory or below satisfactory, I think this could trigger a very serious discussion. Then the same question maybe, Gabriele, do you see any similarity? Because you did also almost 270 billion of investment in the last 10 years, also channeled on SMEs. Are you surprised on the finding of ADB, or also your finding is consistent with the ADB finding? Thank you.
Thank you, Sikander. Thank you very much. Before I come back to the panel, let's see if anyone else wants to join in so that we can then take them all together and have one round. Okay, then the lady and Chao, please introduce yourselves. And then I'll group the questions. I'm taking notes, I'm grouping the questions, and I'll give you some suggestions on how we can efficiently answer them. Please introduce yourself and go ahead.
Yes, thank you for the panel for the very interesting discussion. And I am Rachel Zhu. You can call me Rachel from Beijing Foreign Studies University, Assistant Professor in Development Economics. And I am an independent evaluator as well. So actually, I have a strong research interest on financing for MSMEs. So actually, our team finds out that during the COVID and after COVID, that MSMEs in China who transformed or reformed to have a digital component actually perform much better than other companies. And also we see this strong trend of transform to adapt to the digital economy. So based on multiple MDP's evaluation or knowledge sharing, that's the panel. It's not specific to anyone, but do you have any experience can share to us or good practices about the banks to promote digital finance for MSMEs? And also, because I noticed like we have thematic focus on digital companies, or we have these business adversary. Do we have these components for the MSMEs to transform better for the digital economy? That is my question. Thank you.
Thank you. Chao-san, please go ahead from NDB.
Thank you, Ashwani. Just my question further builds on what his AIB colleagues asked. Based on the evaluation result, I want to further ask, what do you think is our comparative advantage as a multilateral development banks when we're dealing with the private sector, especially based on the ADB's evaluation finding, almost 50% that we think is less than the satisfactory. Because when we talk about the peers, for example, especially commercial banks, compared with us, they're definitely more swift. Less requirement on reporting, no requirement product procurement, environmental, social safeguard, and less monitor and evaluation activities. But as MDB, we always want to push in something more, such as the impact, how to balance the additionality versus the profitability. And when we really see the result, for example, tell us almost 50% less than satisfactory, are we really using the right framework to evaluate those operations or not? It's something we should consider maybe further to change our mindset regarding the evaluation framework? Thank you very much.
Thank you, Charles. So let's go back to the panel now, because I think we have really quite a lot of questions. So my suggestion to the panel, but of course feel free to, yes, feel free to go ahead, is that I would like Gloria to please take the following question so that we don't repeat each other and that we do cover all the ground. The issue of the extension of the projects and how you deal with that, because that was specifically addressed to you.
Right.
But also if you could speak about the baseline issue.
Sure.
And also the success rate that was raised both by Sikander and Chao Sun, and the implications thereof. There was a specific question for EBRD on averages, yes? And also, if you could please, if you could also comment on what, I think Sikander also asked you, what is your experience in the bank, in your bank, about the success rate and the implications thereof, if you could also maybe comment on that. And if you want to share some thoughts on the digital finance for SMEs. So I'll leave that with you. Whereas Aron, do you want to comment on the theory-based evaluations and MDBs in general? And of course, other colleagues from the MDBs, I see the director of ADB is here. If he wants to say some words on that, he's welcome to also chip in. But Aron, there was another question to you as well. No, there wasn't to you, but I would like to attribute that to you about how do you actually reach remote communities in terms of SME financing. If you could also cover that. And I think with that we have, well, also you could take the last one, and then we have covered all the ground of the comparative advantage of working with the private sector. What is our comparative advantage? So I think the panelists have, each of them have a good set of questions that will, and the responses hopefully will complement and not necessarily overlap. But as I said, there's flexibility and feel free to go ahead. But spend only, we don't want to spend too much time, 3-4 minutes each if that's fine. So over to you, Gloria.
Okay, yes. No, thank you very much. My goodness, everybody was paying attention to my presentation, and that's good. I should have spoken faster. Yes, okay, so on the first question on the 30-month, actually, sorry, maybe I wasn't clear. So projects are eligible to be for self-evaluated after they reach early operating maturity. In the case of financial intermediary loans or equity, it's 30 to 36 months. But that's at the self-assessment by the operations teams when they can do it. If there's an extension to the project, they don't have to necessarily prepare what we call an XAR, which stands for Extended Something 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 Assessment. I forget. I should know because I lead the quality review for ADB Private Sector Operations at IED. So it's not that they have to be validated at that 30-month period. It's when they are eligible to do their own self-evaluation. But if they're not ready, they don't have to. So that's the answer to the first one. The question on poor baselines, actually, and then you said there's baselines. Actually, there are poor baselines. We've looked at many projects where at the onset, right, when the projects are approved, you have to set targets for whatever the indicator, and then the baselines. And then at ex post, when they do the self-assessment, we find that the actual baseline that they had originally was wrong. They thought, okay, at that point they had reached, for example, I'm just randomly thinking an indicator, they had 500 MSME, reach at that point, or they had a certain NPL. And then when it comes to the validation or the self-assessment, they realized that that number that was provided by the client for whatever reason, because they don't have the databases in place, they didn't monitor the data was wrong. It was basically wrong. And projects are. We have at ADB, maybe I don't need to go into this level of detail, but there are times that you can do changes in scopes if there are exogenous or endogenous reasons as to why you're not able to meet certain targets as you implement the project. And then the last one, sorry, the other question was on the 50-50. This is the fun one. So on the success rate, I probably shouldn't say this, but maybe Nathan, you correct me. You can compliment. This 52% is a validated success rate, right? So the teams themselves, and this is a small sample that we just picked, and it's very particular, obviously, focused on MSMEs. For your knowledge, the actual self-assessment rating was 84% success rate, self-assessment. we downgraded 8 out of the 25 projects, 32% during the 2018 to 2023 period. And often is because they don't meet certain development results targets, or because, so I mentioned we have 4 categories. It's the same thing at XPSRs, you know, and I was at IFC, I worked with IEG as well. So yeah, but yes, of course, there are tensions. We have, with the operations teams, and we have a variance, which have, for the self-evaluation number and the validation number. Probably shouldn't say, but since I've joined doing the quality review, it's actually, the variance has increased slightly. I don't know if I'm a little stricter or not, or what it is, but you know, the methodology is what it is, you know, which is the last thing that you mentioned, whether, you know, we should revisit, perhaps it is, you know, there are areas that we are thinking of doing amendments within ADB. I know at IFC, at IEG, they're also updating their guidelines, their XPSR guidelines, especially to align with their ex-ante framework, the AIM framework. So, yeah, something to think about. I don't know, Nathan, if you'd like to comment. But
Please feel free, yes, if you would like to. Please, Nathan. I think we need it for the recording. Sorry about that. There's one behind as well, if it's easier, yeah.
Can you hear me now? Is it?
Yes, please go ahead.
Yeah. Is there anything particular that you want me to opine on? Because there was wide-ranging questions there. Even on what Gloria covered, there were quite a bit. Is there anything specific that you want me to talk about? Because I know you're pressed for time, right?
yeah.
And so
Maybe after, or if anybody, yeah, if something's not clear.
is there any one particular thing?
Well, yes, if you don't mind, I don't want to put you on the spot because it's not an easy one. I think this thing about theory-based evaluation.
Right, okay.
I think that's very interesting. It's been talk of the community for more than a decade. I'm not sure to what extent we are actually applying it, and especially when the projects are not even designed with the theory of change. So perhaps you could give some insights on that. I think that would be helpful.
Sure.
And then we'll also hear from Aron on the same topic, from his perspective. I'd love to hear you as well. Thank you.
No, absolutely. So first of all, let me start with this important context, right, which is there is a huge difference between how you evaluate private sector operations and how you evaluate public sector operations. Okay? These are 2 different objects. You don't want to have the same evaluation methodology for both, which some MDBs have done now. They've combined the methodology for both public and private. And that, I feel, is the wrong approach, because these are 2 different objects will need to be looked at differently. This is tied to your theory of change and the theory that you use for evaluating projects. Because at the onset, ex ante, for any intervention, for it to succeed, you want to make sure that there is a proper results chain established, right? Because you are a drop in the bucket in many of the big countries where you're operating in. So your inputs translate to outputs, and these outputs are translating into outcomes over an extended period of time. And so there is connectivity that comes into play, especially between outputs and outcomes, right? There are some channels that you hope you're going to follow to achieve the outcomes from the outputs. That is the theory that you want to establish ex ante before you go into an intervention. And this goes back to some of you actually talked about this, which is doing proper due diligence and understanding the market before you go in. And so there was, EIB talked about not having a targeted mechanism, and I think this was repeated for EBRD as well. That means you didn't have a theory to go in, right? And I think if it was properly evaluated, I think you will have a very low success rate because you didn't have a target in terms of what channel you were going to follow. And so there is no attribution there. Things might have happened, but in spite of you, right? So in order for you to be value-adding and additional in any particular intervention, especially for an MDB, you got to lay it out and say, okay, here are the pathways as I understand it, which I call the theory, right? And then say, okay, here is one particular pathway that is proven and has been evidenced, and that is what I'm going to piggyback on for this evaluation. And you have to say, okay, it makes sense in this evaluation because there is no financing, or there is no capacity, or there is no advisory, right? And I think that is what needs to be established, is have a pathway. I call that theory. I call it a theory of change. And then make sure that you understand who else is doing what, and you identify a gap, and you say, okay, that's my value addition. You come in to provide that, and then ex post, after the operation is finished, you come in and say, okay, I actually did it. And that's why this transaction was successful. That is an idealistic scenario, right? What we're talking about here, in most cases, doesn't work. Even in ADB, it doesn't work, right? So most of them don't have a theory of change. You on lend, it's a wholesale business. You give a whole bunch of money to an intermediary, and money is fungible. It goes in there, and they use it. And you don't know where the money went. This is what happens in ADB day in and day out, right? Because we don't lend, unlike in EBRD, which they said a small piece of it goes directly to SMEs. We don't do that. Most of the MDBs are just giving money to an intermediary, and the money goes through, right? So I think in especially those kind of situations, I go back to this theory question, which is, I think we have to link to the policy side. We have to link to the other side of the bank that is actually doing the groundwork in terms of enabling environment, understand what's working, what's not, and then come up with an intervention theory. So I don't know if that helps.
Thank you, very insightful. Very, very grateful that you took the liberty to share your thoughts. We will extend by 10 minutes only, up to 3:10, and then you'll have 20 minutes for your coffee break before the next session. But I want to go to Gabriele now, because there are a set of questions specifically addressed to the EBRD. Over to you.
Thank you, and thank you, Nathan, for the insightful comments. Let me be a bit more challenging, and taking the point made by Chao and Iskander as well. What is success? What is success? Do we really trust the logical framework that we build ex ante? Eventually, we don't build anymore in EBRD. We think, for example, that the demonstration effect it's a proxy of what is potential a positive result. But what is really success? So the self-assessment says, I don't know, 80%, you were saying. Evaluation says 50%, really. So I think that is something that we evaluators, we need to a bit think about. One of the issues that we had in this evaluation was really to reach the ultimate beneficiary. So that is the point, really to have a sense, understanding what is really the effect, indirect effect, induced effect of our financing towards the final beneficiary. So in the interest of time, I will just take one point that is related to this on the digital divide, the digital agenda, how EBRD promoted it. In our ex-ante assessment of the project, we aim to, prioritize the most impactful projects. And we included the digital component as one of the key drivers for the project. And we had, of course, again, we cannot be fully sure until we have the data, but ex-ante, it is something that has produced an increase substantial in digital innovative projects. So I think that also here there is a lot of room for collaborating across institutions to think about all these issues.
Thank you very much, Gabriele. Aron, over to you.
So you assigned 3 themes to me. Let's start with the theory-based evaluation. Well, I'm not a very well-trained evaluator, so I'm not really sure what we mean on theory-based evaluation, but I can share my thoughts about that anyways. So as Ashwani mentioned in my previous life, I worked for central banks. And monetary policy is a field that's kind of like overwhelmed with research evidence. Basically, every single question and every single sub-question has like thousands of papers already available. So you have like a huge selection of theoretical and empirical work to build on how to run your central bank. And when I moved to the EIB, I was really surprised by the how scarce is is what we have in terms of economic foundations on operations of MDBs in general. And this is also true for SME type of business. public sector involvement in the SME field has like very little literature to build on. There are a few very, very good papers by especially from colleagues from the World Bank that took this agenda over the years and pushed. So, but still, there are some fundamental questions that when we started this evaluation, we actually started to look for literature, and for very fundamental questions that we bumped into, we just couldn't find anything. An example is like whether we should provide liquidity to financial intermediaries or whether we should provide risk-sharing instruments to financial intermediaries. In which situations one is better than the other. There is not much answer to that in the literature. So what we have been doing is to, when we started this evaluation, we actually hired some academics as consultants who provided us papers in two aspects. The first question that we wanted to answer is like how to measure the SME financing gap. How can we quantify, like what's the gap that we need to fill in? The second question is related to this choice between risk-sharing type of instruments, guarantees versus liquidity. We had a very fruitful conversation and cooperation on that with Professor Thorsten Beck, former World Bank, and now he's with the European University Institute in Florence, and then two professors from Barcelona, José Luis Pedro and Javier Frejas. And while we couldn't answer all these questions in entirety, they provided us with some great insights that were built into the evaluation. Another aspect where we used kind of like a theory is measuring impact, where we have been using quasi-experimental methods. We were quite lucky because we have a lot of data on SME level data. So the intermediaries report us back the SMEs that they have been working with their tax code. We can use this tax code to identify these SMEs in commercial data sets. So we can build like quasi-experimental models. So we have been using this kind of evidence to check on impact. The second question is about how can we make sure that we actually reach the most vulnerable groups. That's a very, very difficult issue. We don't have like very firm answers, but I can provide you some opinions and some guidelines that I think are important. The first one is like it's very important to find the right institutional partners. We also should look beyond commercial banks and try to identify microfinance institutions that have some experience with that. But sometimes it's not the usual suspects that worked better. We have some examples in our portfolio where large commercial banks had made the extra mile and made the effort to reach really vulnerable SME groups. And we had also other examples where like national promotional banks who had like the mandate to reach these groups didn't really or couldn't really work efficiently in this field. The second aspect is that to reach these groups, you have to have a strong element of risk sharing. So you have to take the risk away from the intermediaries. And also, because of the high level of risk, these operations are usually not profitable. So you have to have some sort of grant element built in the picture. So you need some partners who provide this kind of grant elements generally. The third aspect is that this is a very labor-intensive process. So you have to provide the right incentives for your operational team. So if you provide them with like, okay, you have to deliver volumes, then probably this will never happen. So you have to create the right incentives and incentivize the people on the field to do the extra mile and go after these vulnerable groups. Okay, so the third topic is like, are MDBs well placed for doing SME lending? Well, it's a good question. The question is like, if MDBs are not there, then who else will do that? Well, national promotional banks can do that, but I think they have also some expectations. I think it's also very important to cooperate with them, so to join efforts. I think what's also very important is the cyclical aspect of the SME financing gap. So you need actors who can have ammunition in crisis times, who can inject funding and risk-sharing capacity in the system when SMEs are most vulnerable to access to finance, and I think MDBs can play a role there. And I think the question you raised about profitability and that versus additionality is a valid one. I think it's very important to find the right balance between the two. But I think that translates to all operations of MDBs. I mean, we are always in this schizophrenic situation that on one hand we are banks and we have to deliver results and we have to serve by somehow. At the same time, we are a public policy institution who has to deliver on public goods. So I think this dichotomy is present in many aspects of our lives. So I probably stop here.
Thank you very much. I think we have covered the ground and we need to bring this to a close. But before I do that, I'll go back to the panel and give them only 1 minute each, and I will monitor the clock to say a final word. And the final word is that, wrapping up, having listened to the 3 presentations, 3 different types of presentations, I'd like to ask each of them, what do they believe is the major challenge in SME development, SME financing, from their own experience, from their own institutional backgrounds? So, Gloria, would you like to go first? But very short, please. Something high level to, take-away message for us.
What is the, let me think about it. Yeah.
Okay. I can go.
Yeah, let it go.
And it could be on evaluation methodology. It doesn't have to be on the sector itself.
Okay.
It could be on methodology, process, because we're here in the Asian Evaluation Week. It could be anything that you think is significant. But let's go with Gabriele, go to Aron, come back to Gloria. Gabriele, over to you.
So thank you very much. That was a really good discussion. I would say 2 things. So one is stressing the point that Aron just made, the viability of donor funding, right? So inevitably, to not leave anyone behind, there is an element of concessionality there, and we need the donor support, to do that. So and you can see that there is a declining trend in that, of course. So this is one. And from a more an evaluation perspective, I have to say I'm quite skeptical on the data reported just by our financial intermediaries. We also have good data from FIs. But are we sure the fact, for example, one of the limitations of this phase 1, that's why it will be a phase 2 on result, but the limitation of this phase 1 that we didn't have the access because of a number of constraints. It was not just because of a tight timeline, legal, administrative obstacles to get access to the ultimate beneficiaries. And that, I think, it's a very important point that we need to keep in mind when we touch the topics of support to SMEs.
Thank you, Gabriele. Aron, before you go, although it was implicitly raised when someone spoke about baseline, etc., but Gabriele has opened up a new dimension, which is the quality of data that we get from our partners at the country level. And this is quite a subject I think we need to keep in mind, especially for evaluation work. And I'm sure you have a lot of experiences about that, but it's a major, major challenge. Okay, Aron.
Sorry, if I could also complement that last point, I guess, just quickly. I think one of the issues that we face more on the evaluation front in general is the difficulties in actually gathering and verifying evidence to substantiate the claims that are put in, out there by the projects, right? And hence the ratings. At least in the case of ADB, we often have to go back and to the operations teams to be able to gather information. We do not have access to the client themselves, so we have to depend on the data that's provided directly from the client to the operations teams and the operations teams to us. And often they don't have the right data systems, reporting systems, et cetera, and the accuracy of the data, it's something that it's very hard to validate. Maybe I could just say that.
Thank you so much. Then over to you, Aron.
If I had to name one challenge, both from the operational point of view and also from the viewpoint of evaluation, is the intermediated nature of these operations. So we have clients, which are the financial institutions, and we have final beneficiaries, which are the SMEs, and they are not the same. There is this principal agent problem that underlies the whole story. We give money to the banks, and we trust them to provide the right incentives. So it's difficult also for the operational point of view. I think there is a tendency to please the client, and then during this time forget a little bit about the ultimate goal of their objectives. And also from an evaluation point of view, you have a lot of data on the banks, you have a lot of information on the financial intermediaries. It's very difficult for the evaluators to actually go to the next step, gather data on the final beneficiaries, get their experience, know whether the banks delivered on their promises and so on. So yeah, I think this is the key challenge of these type of evaluations.
Thank you very much. Thank you. So let's bring this to a close now. I will not dare to sum up this very rich discussion, not only with the panel, but also with the audience. What really impressed me was the wealth of knowledge and information that is embedded in the evaluation community present here today. And I really feel that we have to find ways and means to get this knowledge that you collectively have, explicit and tacit knowledge, out there, particularly in our partner countries. I think that's where they need this knowledge the most, in remote areas, at the institutional level, at different levels in our partner countries. So that is a plea for all of you to continue your outreach work and your dissemination and your knowledge sharing activities in your respective institutions. Before we close, let's give a bit, and then I have a comment, a thought-provoking comment to raise about the AEW in general. But before we do that, let's give a big round of applause, both to the panelists, but to yourselves as well. Thank you very much. I know there will be...
Moderator as well.
Oh, thank you.
Thank you.
Thank you. I know there will be a recording of the session, which will ultimately be made available. But you know, one thing, this is now the second time in succession that I have attended the Asian Evaluation Week, last year in Bangkok and this year as well. And I have attended some of the previous editions. And I find it an outstanding platform for exchange of experiences, discussions on evaluation methodology, on substantive sector issues, networking, and we should not undervalue the significance of networking and building those partnerships when we come together, and we can take those partnerships together bilaterally or multilaterally. But you know, what I feel about, and it's not about the Asian Evaluation Week, it's generally about these conferences, is that what next? Beyond the objective of having this opportunity to come together once a year or once every 2 years, what does it really mean? Or is that enough? Maybe this is enough as an objective, just to network, to share knowledge, information, and build your bilateral contacts. But it would be nice if there would be some concrete outcomes with actionable points for the future. But this is not a conversation for this session now. I leave that with the AFDI and ADB to reflect on if something beyond what we are already achieving needs to be done to make it even more effective and useful for the international community. With that, thank you very much and have a good afternoon.